On the surface, stocks didn't go anywhere today. Really kind of small range, flat moves. Underneath the surface, big rotations going on. I'm going to talk about what those were, how that impacts market posture going forward. We're also going to take a look for a trade idea in a sector that's one of the worst, if not the worst sector in our rankings that had a big jump higher today. I'm going to talk about what sector that is, what caused that jump, and how we can take advantage. Let's go ahead and get started. Today is Wednesday, September the 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the Market Scholars logo right here, then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video today? That's number one. And number two, it tells me, David, let's do this again tomorrow. And the day after that and the day after that. So really quick and easy way to give us feedback with one click right now while you're watching. Also comment on anything that stands out to you down further below on the YouTube video here. Join our daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click that link and subscribe. Really easy way to do that. Follow me on Twitter, for more content like this throughout the day. Also, join our Market Scholars or Market Outlook community on Facebook. You can also join our community on MarketScholars.com for free. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and you see almost a cluster. Not really, but we didn't quite get all of them above 80, but still, all of them above 66. Shows that we've got a strong intermediate trend and some stronger short-term sentiment. Keep in mind that we are kind of struggling at that old near-term high. That's been the expectation that even if we do get above that high, the expectation is maybe 29.30, which is be right in this area here, according to the Fibonacci extension. So, we're getting slightly higher highs. With what would right now be the lower near-term highs in the blue line. Excuse me. We are kind of tapering here. We're really tightening up on the 4-week range. We're tapering. That usually leads to an intermediate pullback. We've seen before in the past where it doesn't. Over here we really tapered and we started to get an intermediate pullback and we didn't. Instead we bounced and broke out and continued higher for another couple of months. And you can see that when we make that bullish move more than what is expected, then this is what can happen after the fact. So the more we go higher, more than expected, the more it gets corrected and can be corrected very quickly. It's okay to get these pullbacks, right? And right now, we've got some strong support in these areas at 38%, 23% Fibonacci retracement, 38%, 50%. So it's not going to free fall here anytime soon. There wasn't nearly as strong support in this area because it was so fluffy. Not very fluffy here. Lots of volume, lots of support in this area. So as we do pull back, we'll look for a low point like this to occur somewhere in this range that we can bounce off of, and then make that end-of-year seasonal bullish run that we typically get. We don't have to get, but typically we get heading into the end of the year. That's the seasonality for the S&P 500. So as of right now, we're bullish. The trend is still bullish, strongly bullish. The short-term sentiment's bullish, but not quite above 80 where it would kind of confirm that. We had a nice good bounce off a bullish low point. Last Monday, we talked about this bullish intermediate confirmation signal that could lead to a higher day or two. I don't expect it to be that long. The typical near-term run with the blue line above 50 is 7 to 12 days. I'm not expecting that. Maybe another day or two, but we're getting frequent near-term runs. We're getting a longer than normal near-term drops below 50. Those are all signs of a maturing intermediate trend that again would not precipitate a bear market, right? Or even a quote-unquote correction defined as a 10% decline from these highs. I'm not looking for that. All I'm looking for, until told otherwise by the markets, is simply Fibonacci retracement. And Fibonacci retracement happens to line up in multiple areas with old lows and old and strong levels of support, of volume support. Let's take a quick look at the Dow Jones Industrial Average. You can see it's the only one that hasn't broken its January highs, and it's sure trying to make up some of that gap. A good bullish move today, strong bullish posture, strong short-term sentiment. Again, the possibility of that divergence is there. Obviously, we came off a higher near-term low. We're already easily to a higher near-term high, but as of right now, would be a lower high on the market forecast itself. Then you take a look at the NASDAQ not rallying like the S&P or the Dow. Actually has a bearish posture. Falling market sentiment, albeit at very high levels, so don't read a whole lot into that. But falling intermediate line, lots of pink shadings here, and bearish near-term high. We never did break below that low, so a good sign that we didn't get a bearish near-term low point. But you can see we're not really breaking the new near-term highs yet either. So you can see what's going on with the NASDAQ composite and the Russell 2000, which did break below that low point on Monday, showing the bearish posture, not showing a strong near-term decline, but you can see we're right back at Monday's low. So again, not that these are telling us, hey, oh no, the world's going to end. Of course not. But it is telling us that dark pink shadings are on the horizon, and that's not a bad thing. It's good to be orderly. It's good for the markets to be orderly. The more disorderly they get is when you get these kind of moves that we experienced earlier this year, when we had that disorderly move higher at the end of last year into this year, beginning of this year, with the tax reform related repercussions. All right, a quick reminder that you can watch our Market Outlook video on our blog. Just go to marketscholars.com, click on blog at the top of the page, go to the most recent Market Outlook video. You might have to scroll down a little bit, but you can find us here if you're not already here. If you are here, remember we look for 3 clicks to tell us that you want us to keep doing these videos. I've mentioned before already to like the Market Outlook tweet. You can do that by clicking on the heart and then click this like button there. You might have to log in if you're not already. You can also click this image. Will take you to your Facebook page where you can like tonight's Market Outlook Facebook post. And of course, you can like it here on our blog by clicking that button. Those 3 clicks are what tell us. So as we see these numbers go up or down, that tells us, hey, we should keep doing these videos, or maybe we shouldn't, because it doesn't seem like there's as much interest anymore. Also, remember too that you can continue the conversation between this video and the next one by going to our Market Scholars forums there. So whether you have questions or comments on the video tonight, or questions or comments on something related to the video that we didn't discuss, you can get mine and Brandon's and other Market Scholars takes on it there as we go back and forth in the forums. You have to subscribe to participate, and you can do that by clicking on this image right here. We'll take you to our subscribe page where you can do that, like I said before, for free, of course. Right below that is our calendar. Brandon's got his Strategy Lab class coming up tonight, as well as his really popular multi-hour Q&A session that he does with our premium Market Scholar members here tomorrow. Again, another sign to not expect extreme bearishness is, remember, we are above a rising 50-day moving average, which is significantly above a rising 200-day moving average as measured by that gap down here, the MACD. Yes, there is a bearish divergence setting up on that MACD. Yes, bearish divergences can work themselves out, and it would be a pretty deep low point, but it usually takes months on a weekly chart like this for that kind of a time frame divergence to play out, especially at such high levels. Usually it'll get progressively lower highs and will really slow down by the time we grind our way down and break below the 200-day moving average and stay below it, like we did at the end of 15, beginning of 16. Of course, on the Hakinyashi, you can see still a good bullish candle, higher close than what we had the last few weeks, higher close so far than what we had over here a few weeks ago. So again, kind of hard to be too bearish here. We can expect some pullback, but we shouldn't expect steep declines like we're seeing in some stocks, famously in some stocks today, at least at the end of the day and into the after hours, as you see in Tilray. There is a Dow Jones Industrial Average. You can see it's got a very strong Hakinyashi, not so strong in the NASDAQ. So there's the NASDAQ, small bodies, upper and lower shadows, signs of weakness. Not, it can be reversal, but at least signs of weakness. And then finally the Russell 2000, you can see the same thing. Small bodies, upper and lower shadows on the Hakinyashi, signs of weakness in this bullish trend that we can reverse. And again, that we can definitely, you get below the 50-day moving average with a red arrow. It doesn't mean we have to go to the 200, but usually means intermediate pullback at that point. Look at the 3 green arrow chart for the S&P. You can see we still got 2. We don't have that green arrow on the MACD. This is what it looks like when you break out the lines. MACD is rising, but still just a smidge below its moving average. That's why you don't get the arrow there. We are back above an 8-day moving average. There's the extensions I mentioned before. You'll see in a minute. Stochastics above a rising moving average. So, stochastics above it, but not the MACD. You're above this 8-day, but we're not clearing the new high. So we're bullish. We're not strongly bearish, but we're also seeing signs of weakness that we should account for. Look how tight today's range was. Very, very less than a point. Very tight range. Higher high. Almost a higher 4-week high, higher low. I did tweet out here. Here at the bottom right here. The 4-week range is tightening up. This is the price channel. The 4-week range here is getting really tight. What that usually means is, as I've mentioned to you before, this lower line's rising. And again, unless we break up the new highs, it's going to tighten up some more at the end of this week after this falls off and we move up to there and then we move up to there. That's where the 4-week low is going to be, and that's going to be a 5-point range, and that's about where we got to before previously when intermediate runs run out of gas. So we started off with a pretty a big range when this intermediate posture really took off. It's been slowing down. While we've been pointed higher, and as such, the range tightens up. Here's the purple line, remember, is the open of this Hakinyashi. So we're not in danger of any kind of signs of weakness on the S&P 500. But when you look at some of these other indexes, there's your SPX, and of course, I've mentioned to you before, there's the target for, based on the extensions of where we can go up to on this current near-term high point. That's why I don't think we'll get up to significant new highs. When you look at the Russell 2000, we are a lot closer to the 4-week low point than we are, and that 4-week low point is actually going to change all the way up. We'll change to today's low, so we will be at the low point for the Russell 2000. And then of course, when you look at the NASDAQ composite, we are in the lower half of the chart. At that low point is going to change in a few days too, and get up to last week's low essentially, and we'll be trading even more in the lower half of the chart. That's not in danger of coming down anytime soon, the high point. So the Dow and the S&P look good in terms of where they're trading, and Dow getting a new 4-week high today and really wide range. But not the NASDAQ and the Russell. So those two may be the precursor to what we see on these kind of large cap indexes that eventually will follow them down. If we take a look now at the today's range and the range here for SPY and the volume, you can see the range was below a point. The average range right now is 2 points, just under 2. We were below 1 point today, and the volume at 48 million down here in the bottom right corner of your screen. So let's look at that on in its context. Again, the trading range below a point. That the low end of the 52-week range is just over a point. So very, very small range, very small volume. 48 million below the 52-week average range there for the average. And of course, the relative ATR still in the bullish territory. Again, over 1% moves. That's the sign, right? That's when your range is over 1%. That will mean a 3+ point with above average volume in 100 million. That's when things are going to be bearish and probably stay bearish. We're still not seeing that yet, and as we tighten up, look for breakouts that will exceed those numbers. Now, if we get like a 5-point range or a 5.5-point range with 200 million shares trading all in one day, buying opportunity, buy that dip. Usually when you get extreme selling and all in one day, you flush out all the sellers at once. It's the consistent above average ranges and volumes that gradually move us lower. Finally, we'll take a look at volatility, and it really dropped down below 12 today towards the low end of this range we've been in. When you look at it on a relative basis, very, very low, almost below 80%. So, setting up for opportunity for a jump higher in volatility, potentially after this expiration cycle that ends here this week on Friday. All right, to summarize, the trend still remains strongly bullish, and as we've seen in the past where when we've seen periods of weakness, signs of maturity, where we expect more of a pullback and it breaks out to the upside instead, we've seen how that can be corrected pretty quickly and pretty sharply. We don't see signs of that yet, but of course you need to be aware of that with the expectation that all of these signs are pointing to an impending intermediate pullback, not a bearish correction, not a bear market, not a 10-20% correction like we've seen in some other countries, mind you, in these major economies. But and actually it will be those other countries and economies that will keep us from having a significant pullback. But still, that pullback is impending, and we're seeing more signs of that as we go. So what do you think? Do you agree with that posture or do you disagree? Click that link in the top right corner of your screen and click on either agree or disagree. If you disagree, scroll to the bottom. Love to hear what you're seeing that would suggest either that we are already more bearish than what we're seeing, or that we've had the pullback and now we should anticipate more of a bounce going forward. So let me know there down in the comment section below. All right, it was a down day for stocks and bonds, but not like stocks in general. As you can see, the S&P 500 was up. IWM was down, MDY was down, so a little bit of broader weakness. The strength is kind of in smaller areas, but you can also see real estate stocks were down, dividend stocks were down, preferred stocks at their 3-month lows, MLPs coming down, high yield bonds coming down today, long-term bonds getting oversold clusters, as well as municipal bonds getting a cluster of oversold clusters. So bonds are down, which means yields are rising, but also stocks are falling. Individual or alternative asset classes within the equity markets, as well as these broader areas. Value holding up more than growth. So again, another sign of lower risk appetite. Not necessarily risk aversion, but at least lower risk appetite. And you can see all these down here at the bottom, all with the biggest losses on the day. There's high yield coming in below. Let's see, where is it? Liquid right there, just barely. Those are both falling down today. Liquid, this would be investment grade bonds there. And of course, AGG, which is a total bond market, down, and ACWI, which is a total equity market, including foreign stocks, up. And a lot of that foreign stock coming from emerging markets. You can see really taking off today, along with the commodities, agricultural and regular commodities here. And you can see crude oil, the biggest winner on the day among these major asset classes. Something else I tweeted out earlier today too was the S&P 500 had an up day, and what's keeping it afloat right now is the strength that you're seeing in these areas that were weak for so long. I mean, look at this jump up in Japan, look at the jump higher above their moving average, and China. In fact, all of these now, except for UK, is kind of flirting, and Germany is kind of flirting. India bounced up today, but it's still below its moving average. You can see Russia is well above its moving average, Canada getting above. So all of these foreign markets that had been pressured with some real weakness over the last 3 weeks are starting to bounce higher. In fact, I've changed this column here to be over the last 7 days. So a lot of this big move here that you're seeing in these areas, you can see Turkey, Russia, Thailand, Japan, China. So a lot of these Asian emerging markets are really leading the way. Of course, you got Mexico and Argentina. Brazil is going to be down here, not as much of a game, but there's the U.S. stock market. It's up in the last week and a half, almost 1%, but it's really lagging even the developed foreign markets. There's France right there, and then of course Germany at 2%. So some good signs for these developing areas. Of course, a lot of this has to do with what you're seeing in the U.S. dollar. So the dollar, you can look at here on the weekly move, and if you look at the Hakinyashi candle, we're getting a bearish week, and momentum is falling on the dollar at that Fibonacci retracement level. Of course, a break below right here. Let's pull up on a daily chart. You got strong bearish posture on the dollar. A break below this 38% Fibonacci retracement, essentially getting below 94 and staying there will be significant. I mean, of course, that we had a kind of a false breakout above 94 there before breaking above it, holding it, testing it a few times and bouncing. So a break back below 94 and holding it, not doing this kind of a move to get back above it. If you were to break down and stay down, of course that would lead to continued outperformance in commodities like crude oil. See, here's the chart for crude oil. Trying to break out there to the upside, and also like a gold, which has been really beaten down. In fact, let's look at the long-term chart of gold here. The 50 and 200-day moving averages. I mean, look how bad it's been. So there's opportunity for it to reverse. Now, it hasn't closed above any of these highs, so we're not looking for a change in direction anytime soon. But weakness in the dollar. See, weakness in the dollar helped the gold do that, and that was a good year for the U.S. stock market, but it wasn't nearly as good as it was for these international markets, 2017, all during this period. So, if we were to get a move lower again in the dollar, that wouldn't necessarily mean the U.S. stock market's falling. We can still continue higher. We'll just be led higher by other areas of the market. Like those developed and emerging areas, the material and the energy sectors have been really beaten up too. They've been down towards the bottom of the list. Materials is breaking out to a new 3-month high point. Energy is back above its moving average finally. It hasn't been green for a long time. Financials making a decent breakout move today up to new 3-month highs as well. And it's been a beaten up sector with the yield spread falling, yield spread moving higher today. But some of these others, look at utilities dropping, or real estate dropping. Of course, higher yields will do that to those particular industries, but you can see kind of breakout moves there. Industrial still strong, healthcare still strong. You can see some relative weakness in staples and technology, staples technology, a little bit of discretionary too, falling, still above 80 but falling. So a little bit of a reversal here. Financials, materials, energy, industrial. This is a rising yield, weak dollar environment. Now that's not a long-term relationship. Usually a strong dollar goes with rising yields, but it doesn't mean you can't be opposite in the short term. And so that's your typical move. And higher yields puts pressure on these interest rate sensitive areas. And you can see also on consumers. Sectors are pushing their way down with the weakness in the dollar, pushing technology and discretionary below the S&P's performance over the past week and a half. Of course, when you look at the 3-month chart, you can see the big drop and decline in utilities. There's your industrial strength, there's your healthcare strength, so they're still maintaining. But these two lines right here, purple and blue, that's your utilities and real estate. They're really dropping. The other two performers that have been holding up well is discretionary and telecom. They're pulling back, and you can see the big winners. Here is financials, here is materials, and there is energy. So they're your big winners in this environment. As you can see from this chart, they have room to run to continue to show some of that outperformance with rotation coming out of here and into these bottom areas. If you take a look at this chart, here, let me go to a time frame, and I'm going to go to a year. I'm going to do a custom year, excuse me. I'm going to go from the beginning of 2017 to the end of 2017. So let's just go up to 2017 here, the 31st. All right, so remember how the dollar had such a good run during that time frame. Of course, technology's up there, as you would expect. If you take a look at the energy sector, this dark brown, you can see kind of what it did, down 5%. There's telecom, 5% there. Materials is this green sector, up 21%. So, energy really got beaten up early. It started to make a run late. In fact, if you look at from August the 21st going forward, so let's come back here, and then let's go August the 21st going forward. There's your strength in energy taking off, and materials continue up higher too, and financials during that end of year run from August the 21st through the end of the year. If you were to go back to just a regular 1 year chart and pull up that dollar index, 1 year chart right there, and pull up the dollar index here, you can see from here, let's go a couple of years back, 2 years. Again, from this August period, you can see, we had been so weak on the dollar, and we were, ended the year on a decline, especially here from November down and into the beginning of the year. That kind of decline, even if it's just down to 92, even if we just end up forming a little bit of a head and shoulders pattern with a little pimple on the right shoulder that popped up more over here. But even if we come down below 94, we get down to say 91.5, 92 area, we form this kind of long-term inverse head and shoulders. That would still be a long enough of a decline of a move, as you can see what it's taken before, that it can be beneficial to that sector rotation that we're currently seeing the market starting to price in. All right, one of the stocks in that embattled financial area that had a little bit of a breakout move today was JPMorgan. You can see breaking above a key volume area for this past year. This has been a strong area of volume. A lot of volume kind of in this sideways range. We're getting at the top end of the range. We haven't broken out yet, but you can see we've broken out of where most of the volume is. There's very little volume up in this area that can pressure the stock lower. So good sign. You can see why we needed such a big move today to get through all that buying and selling that's occurred in this area. Big strong daily range today, strong move in the last 3 months, up 10% now. A lot of that, big chunk coming today, 3% coming today. When you look at the other charts here for JPMorgan, you can see the MACD, the market forecast. We were below 20 yesterday. We're above 20 today. So big sharp move, big move higher on the near-term line that we haven't seen on all these peaks here. The near-term line never was able to get above 50. Last time it got above 80 was during this period. And you can see here we got above 80 on a breakout move, pulled back a little bit, and then made a run higher. We're going to do something similar here. And, now granted, we were coming off oversold clusters, which we never got there. We were coming off of a strong bearish move, a trend. The market sentiment was coming off. But you notice here, if I were to draw Fibonacci retracements, that we have, this market sentiment is coming above 50, so we're on a current long-term run. We had a pullback into this 38%, 23% Fibonacci retracement area, and we've held. And so this would be a higher intermediate low point, significantly higher. And we would expect, in fact, here's the Fibonacci extension lines I've drawn. And if I were to change this expansion over here and get some more periods over here on the right now, keep in mind you have earnings coming up, but earnings, as you've seen in the past, usually doesn't change the trend of the stock, the moves that you have. We were bullish going into earnings, we were bullish coming out of it. We were bullish coming into earnings. We stayed bullish coming out of it. Same thing here. So it doesn't really change. We are bearish coming into that earnings. We are bearish coming out of it. So right now, currently, we look like we may be bullish heading into it. And as you see, there's opportunity on this extension if we were to break out to get up to 127, if not up into this Fibonacci retracement area, 120 to 121. You can start looking for some target possibilities there. If you take a look at the long-term view for JPMorgan, you can see, hitting that 50-day moving average and bouncing. You can see that, it's had good runs, long-term runs, into the beginning of 2017, into the beginning of 2018. Are we now headed towards another good long-term run at the beginning of 2019? Obviously remains to be seen, but a nice little breakout move so far here today. Finally, the DMI, you can see you actually had both lines below 20 here until today, and then you got the crossover with the break above 25. So a good sign. You can see we haven't been above 25 for a while. We haven't had the trend. We've been, consolidating, and this potentially with the strong volume and the 3 green arrows. You can see it here on this chart. 3 green arrows and the strong volume suggest there could be a good trend trade coming out of JPMorgan. Of course, it would have a relatively large trade risk. Your stop order would be below this low point, so your position would be smaller than normal because of the big size breakout today. But of course, if we trend higher and we get multiple opportunities for new 3 green arrow signals, we can always add to that position later if it trends like it's done previously during this kind of seasonal move. All right, now I want to hear from you. What do you think about what we talked about in tonight's market outlook video, about a market posture, about what's driving the price action, about the trade idea tonight? Any questions or comments on any of that, or questions or comments on anything else we didn't cover? Feel free to comment down below on the YouTube section. Remember, you can also scroll down on the blog post and comment down there, as well as the link above the video on the blog post will take you to our forums where we can discuss the video with other Market Scholar community members there for free once you subscribe in our Market Scholars forum. So as always, thank you very much for tuning in tonight. Remember to subscribe to our YouTube channel, click the thumbs up icon to let us know you want us to keep doing them, and comment. Follow on Twitter for more content like this, and join our community on marketscholars.com or on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.